From a professional soccer career to becoming a driving force in the mortgage industry, Brian Covey has shown what it takes to find your competitive edge. Get off the sidelines and get in the game. Find your competitive edge with Brian Covey.
What's happening, guys, and welcome back to another edition of Finding Your Competitive Edge. This one's going to be a little different because usually with some of our guests, we talk about a lot of different topics and things out there. But today, for our real estate, mortgage, insurance, financial planning, heck, if you're just someone that owns a home or wanting to understand the real estate market and housing, you want to tune in because Logan has been not only a friend of mine, but following him with the HousingWire. He's been on CNBC. They've got their own podcast over at HousingWire, but over 2 decades. And I loved as we were getting ready for this, he has proved a lot of these housing bubble bros, as he would call them, wrong over the last decade plus. You want to tune in today as Logan Mohtashami has been on CNBC, but more importantly, if you listen to what he's actually shared in his in-depth knowledge around reading charts and predicting some of the future, better than anyone out there, I would tell you. We followed a lot of them. You want to tune in today, take notes, be ready to actually learn. What I would tell you is you go into next year, 2024, make sure you curate your feed. Make sure you know who you're listening to. And you don't just have these people that throw stats out there. And typically these stats are not proven. They're not accurate. And they just make for good headlines and clickbait. So, Logan, we're going to jump right into it, my friend. Welcome.
Man, it's great to be here.
Dude, I got to go back to HousingWire. Great event this year. And I will say you were the one that the room got packed. Everybody was excited about what's Logan going to talk about. And I've got to admit, I follow your content that's there. But before we jump into some of the housing and some of the stuff there, you've got over 2 decades. You had a blog. You had things there. You've been doing this for quite some time. Give us a little background into how did you even get into housing and understanding how to read charts and some of the things that you love to do now?
Well, our family's been in banking since the late 1950s. And my father opened up his own mortgage company in 1987. And then around 1996, I got into the stock market and then got into the mortgage business. So just, following numbers and data for a very long time. But around 2010, a gentleman named Jason Resnick from Benzinga asked me, "Do you want to write for us?" And I said, "Sure, I could. I'd like to write about real estate and try to debunk some myths." One thing led to another. I created my own blog, and then around like 2014, 15, I realized something that, wow, there's a lot of bad information out there. It's typically very bearish. So at that point I thought, okay, let's not just talk about housing. Let's just talk about all economics like an analyst would do it and talk about economic cycles and also talk about housing and just keep it as factual as possible. So then people actually will have an avenue to bounce things off. And then toward the end of 2019, HousingWire asked me to write. And I was excited in the sense because my economic work is really separated into 2 time frames, 2008 to 2019. But years 2020 to 2024 was going to be much different because household demographics would be good at that point. And then COVID happened right away. So one crazy analyst on April 7th, 2020 wrote a COVID-19 recovery model and said, "Hey, listen, housing is going to come back in about 6 or 7 weeks. The U.S. will recover. Don't worry about the depression or anything." And HousingWire at first thought, should we publish this? This is really, and they did. And one thing led to another. We tracked all the recovery process. And that's kind of what I do, track economic stuff daily and give people the most factual data, which tends not to be exciting. I always say, if economics done right, should be boring. It's not designed to be the sexy, hot, fun thing with lots of clicks and attention. And we always want to be the detective, not the troll. Mm-hmm. So it's just, I'm here to bounce off reality. And I know I'm extremely outnumbered by the bad, crazy takes out there because that generates most of the tension. But I felt like I did it the right way. And just want to be a place for people to kind of just get the facts, and the storytelling could be done by other people.
I love it. And you do it well. And I love the music, by the way. Being a musician myself, I'm like, okay, let's put some music. Let's make boring data fun, right? And you do that. Hey guys, it's Brian here. I hope you are enjoying the show. By the way, if you're an entrepreneur or a solopreneur looking to grow your personal brand, make a bigger impact, maybe increase your leads and grow your revenue, Let's help you get started today by connecting up with my friends over at the Brand Builders Group. You've heard me talk about them, but if you're new here, this is definitely the first step to get you started in turning your reputation into revenue. Head over to freebrandcall.com/Brian Covey. Again, to set up your free brand call, go to freebrandcall.com/Brian Covey to set up a free strategy call with one of the team at Brand Builders, and they will dive into your specific goals for how you want to grow your personal brand. I can't wait to hear how it goes. Before we talk about 2023, that article, I'd actually thought about that because that was something that really caught a lot of attention. As you look back now through COVID and some of that, what were some of the through lines or lessons that you think we learned or should have learned?
Well, number one, I think the biggest thing that I try to tell everyone, whether it's Wall Street or institutions, I talk to the White House or even Federal Reserve members, that the 2005 bankruptcy reform laws and the 2010 qualified mortgage laws changed the entire U.S. economy. Yeah. And when you have traditional 30-year fixed mortgages, right, you have to look at it as fixed debt cost, rising wages. So when we went into COVID, I think a lot of people saw that, they saw the forbearance numbers and then they thought, well, housing is going to crash at least 40%. We're going into a depression, but everyone's financials that were homeowners were in a good spot. And if you believed, like I did, the recovery in COVID was going to be fast, I coined the phrase forbearance crash bros in the summer of 2020, saying that all these guys on YouTube and TikTok or whatever, they're not data people. You could see this. Housing has a very strong foundation here in America because of the 30-year fixed mortgage. And I think people should just go with that for decades to come. If you have a job loss recession, that can create stress in the data lines. But if you follow the historical data going into COVID, we had the longest economic and job expansion ever recorded history. And here comes COVID. We did what we needed to do to plug the holes, and the recovery was fast. And the history of global pandemics are always inflationary. You have this inflationary burst and then the disinflation that happens after. And just kind of follow the data with COVID. And things, to me, based on how I look at economics, look kind of right where we are today. But that also means you have to throw your ideological takes away and just focus on the data. And I think that doesn't make it as fun for a lot of people, but COVID really showed that if you follow the data correctly, things worked out. Unfortunately, though, the one data line that wasn't looking good was active inventory. That's kind of been my story for the COVID-19. Is we got to levels historically that were not healthy. When I speak at events, I tell people, does anybody know how many single family homes we had in March of 2022? And nobody answers it. And I go, we only had 240,000 single family homes available for sale. Now think of it in the context of we have 335 million Americans. We have over 157 million people working. We have too many people chasing too few homes, and prices can escalate out of control. That's different than the housing bubble years where we had massive credit and sales growth and a big credit crash. So COVID was a really good point. If you just follow data and just go with it, you can have an idea. And it was crazy. Everything was crazy. The housing market has not had a normal year ever. And I think we're all so stuck in 2008 mode, and nothing in the data was 2008 or 2005, 6, 7, or 8. And I think you stick with the data, you go with it. And when there's material changes, the data will let you know when that happens. And even with COVID, with the wildest exchange of data going up and down, models still worked. You just got to listen to them.
Yeah. Man, I love that. And we learned so many things through that, right? And being a homeowner, as people, you look at the charts of being a homeowner, obviously you're typically going to be more wealthy. You're going to have more savings and all that. And that showed so much through the equity that they gained. But you still have people today, Logan, this blows me away. I'd love your take. You mentioned 2008, right? So I was in the business, you're in the business, and you got people going through that they still today, in the end of 2023, want to say, oh, it's going to be 2008 again. We're going to see all this again. Can you explain, your perspective, why that's not the same?
The easiest way for me to say this is people don't remember what the data looked like back then. So Active inventory was actually growing from the year 2000 to 2007. By 2005, if we're going to use the NAR data, we had 2.5 million active listings back then.
Wow.
In 2005, 6, 7, and 8, foreclosures and bankruptcies were all rising during an expansion, right? So the credit markets and housing were breaking easily. I always show these charts and I draw these lines to make it very evident. But by 2007, we had 4 million active listings, and we had major distress pipeline of credit owners going into foreclosures and bankruptcies. Then after all that, the job loss recession happened in 2008. None of that's been happening for 13 years. Bankruptcies have been going the opposite way. Foreclosures have been going in the opposite way. But active inventory today, even after the biggest home sale crash in a calendar year ever in history, we're at a little bit above 1.1 million active listings with 30, 60, 90, 120 days lates being near all-time lows. So you couldn't get two different cycles in housing ever in the history of humanity, not even just in America, on planet Earth, than what you saw from the credit boom from 2002 to 2005, and then what we saw the last few years. The credit quality in America is unbelievable. I always say this, like the world hates us because, when we talk about inflation, the best hedge against inflation was always a 30-year fixed mortgage. Mm-hmm. It's not the asset price, it's the fixed debt cost. So when inflation takes off, your wages grow to compensate for that, but your 30-year mortgage stayed the same, and a lot of people refinance, so their total housing cost is very low to their total incomes right now, especially now, from 1985 to 2007, people are staying in their homes 5 to 7 years. From 2008 to 2023, it's 11 to 13 years, depending on who you listen to. So much different marketplace, much different credit marketplace. So there's no resemblance in terms of credit quality or inventory compared to the 2005 to 2008 period.
Great answer. And if you guys listen to that, rewind it back, because it still comes up. It amazes me. And I'll never forget, Logan, I was at one of the NAHB events in Orlando, if you remember those, and our taxi driver driving us from the hotel to the event that night was talking about the 3 condos they had bought, and they were doing assignments and all this crazy stuff. And I go, guys, like, that's not happening today. You don't have taxi drivers buying multiple properties and assigning them.
The qualified mortgage in 2010 changed everything. And even today, I still think that doesn't get enough attention at all.
Correct. Yeah, I would say for people that are listening to this, if you don't understand qualified mortgage and all that, obviously research it. Our mortgage people will understand it. So great explanation. I knew you'd be able to dial that in because it comes up. Let's ask the guru. Well, let's fast forward. 2023 has been quite the interesting year. Rates getting up to 8%. We saw all kind of craziness. You talked about this. Limited inventory still continues to be this topic where I think you shared it the other day. What are we around? Only 76,000 completed new construction homes?
Yeah, new homes. Whenever I go to speak at different cities, I always ask people, does anybody know how many new homes are available for sale today? We're talking about completed units. Nobody answers, and I say 76,000. That's it. And to be honest, that's almost normal. I think a lot of people thought that the builders would flood the market with millions of homes. Yeah. Even during the housing bubble crash years, they never even had over 200,000 homes available for sale. So the builders don't operate that way. That would destroy their business model. So there's a lot of misinformation out there, but that was one of the more prevalent ones. The last 18 months, people said there's more homes under construction than ever, millions of homes. The builders, even today, right now, have more homes that they haven't even started yet. It's 106,000, units. So people just don't follow housing religiously like I do, but that was one of the bigger myths that happened because majority of all inventory comes from the existing home sales market, and we had a major credit boom and bust, and that led to the massive inventory escalation from 2005 to 7. So in 2023, I think the untold story here is that even with mortgage rates going to 8%, even with home prices getting back to all-time highs fairly quickly in 2023, the price cut percentages, 1/3 of all homes in America have a price cut. Here, even with the period of time where rates got to 8%, we were always 4% below 2022 levels. So if people are trying to understand how are home prices at all-time highs and still rising, well, most sellers are buyers of homes, right? So a lot of times when you list a home, because of qualified mortgage, you talk to your mortgage person and your mortgage says, okay, you can buy a home with rates at 7 to 7.5%, maybe not at 8.5%, but 7.5% is your key. So they put their homes in the market, sellers are buyers, inventory is a wash. If you get more first-time home buyers into the equation, they don't actually provide a home. So this is one of the reasons why inventory has been falling for years. And this is, again, the function of qualified mortgage changed the entire landscape of the U.S. economy, but especially for housing.
I love you going through that because I think people wondered, even coming into 2023, remember there were charts of how much was it going to drop in home prices? That was some of the forecasts that were there, right?
Yeah, it's funny. I was laugh because I would say, has anybody noticed that everybody has either 10, 15, or 20% home price declines? These people just make stuff up, like when I talked about 2023, like how could home prices fall? And I had this, home prices could fall 5.9 to 7.4%, but home sales have to start crashing. Of course, myself, for people who know my work, back on November 9th, I said, okay, the housing market dynamics are going to shift because it looks like existing home sales are going to 4 million. And historically, after 1996, we rarely break under 4 million with duration. That's because we have this core 4 million home buyer. No matter where home prices are, no matter where rates are, they've always been there. And even with rates getting to 8%, we got a little bit of underneath 4 million, but there's no big drawdown. Like 2022 was crazy. We had 6.5 million monthly home sale prints that dropped all the way down to 4 million in 12 months. It took 2005 to 2008, 3 years to get home sales to crash that much. Here we did it in 12 months because basically sellers stopped selling. New listings data, which is a fairly new data line for a lot of people, after mortgage rates got above 6%, new listings data, which was already trending at the lowest levels ever, made another brand new low. So for the last 17 months, new listings data was trending at the lowest levels ever recorded in the history of America. And people are telling you millions of homes are going to go to the market. I said, where is it going to come from? Right? There's not that many product. That's not much product out there to even move. And I think that's the thing with professional grifters and doomsday people. They don't actually read the data or even know about it. So my job is just to facilitate as much data as possible so people can understand. Like, I don't care about the final answer as much as I care about the why. Right? The why and how something happens. So this way you could talk about the story, we connect the dots, be the detective, not the troll. And this way, now that we're toward the end of 2023 going into 2024, we create models for people to track because what we do is we're fortunate enough because we track live weekly inventory data. Not many people in this country have access to that, but we do. So every Saturday, on HousingWire, we have this live tracker that I created at the end of 2022. So people could actually see it. And then you could take all the noise away, right? And nobody can miss anything because the data will be there. And if there's any kind of escalation in inventory or prices, we'll be able to see it because we're like 3 months ahead of everyone else. By the time everyone else gets the monthly data, they're already lagging behind. And it was a perfect time because going from last November 9th all the way to here, everything kind of worked based on what the data and the model was showing. And now we could go into 2024 getting more people informed about what's going on. So there's a more coherent message out there.
I love it. Well, let's talk about that because 2023 has had its kind of attrition, we'll just call it, of whatever the final number ends up being, 40% or so of real estate agents, mortgage brokers, all that are not renewing, possibly not coming back. All that's happening. But you talked about that data, and we're starting to see some of that in the street. So I watch the charts, I read the data, and then I go, what's happening in my own neighborhood? What's happening with my conversations? What are you anticipating over the next 90 days going into Q1, which historically, look, Q1 for a lot of mortgage companies it's scarce, and people are worried, people are dropping off and all that. So I'd love your take on what do we think in the next 90 days?
So if we look at the history of economics going back decades, when the market believes the Fed is done hiking and the Fed believes it's done, mortgage rates fall, bond yields fall down, means people buy bonds, yields falls. The only time that really didn't happen was 1978, and much different story in the late 70s. So mortgage rates have fallen almost 1%. The history of economic cycles show that when mortgage rates go down, demand picks up, especially after 2010. So we've already seen a similar kind of reaction like we had last year. But last year, I didn't think mortgage rates could get below 6% in any way, unless the U.S. was going into recession. Here, the Fed can be more pro-housing for the first time. In fact, I have our own little our podcast for HousingWire. We talked about that. The Fed now can be pro-housing, which means lower rates with duration, not rates getting down to 6% and then going back up to 8%, right? We see that as mortgage rates kept on heading higher, demand got weaker. Now we could talk about lower mortgage rates duration. If the spreads get better, we could talk about even rates getting down 6%. Now, the reason I say this is important is that the new home sales sector is growing double digits. They got sales up 20% year over year, but they're living in a sub 6% mortgage world. So now, if everything kind of works out, you can get lower rates with duration. That means sales and demand goes up. That means more business for everyone, because we're working from such historical low levels. I always tell people, if I look at it per the workforce and how many people are working, this is the lowest levels of sales ever, right? So we got room to go up, but we got room to go up with duration, much different than what we saw in 2023.
I love that. Yeah, and that stability, I think we're all longing for. And last week, or maybe been 2 weeks ago now, the article, I'd love for you to dissect this one, is, there were a lot of people said, okay, the Fed is now saying they're going to have 6 rate cuts over the next year, 2 years, all of this stuff. And it was funny just to watch people put their own spin on it. So I'd love to come to the expert of what your take is on that. And what does that even mean for all of us that are listening?
So mortgage rates have moved up and down. There's no rate cuts happening. Rates have already fallen 1%. We've had rates fall 1.5%, 1% without any rate cuts. The bond market runs the show here. So last year, a lot of people thought the U.S. was going into recession. Rates fell noticeably. You don't necessarily need rate cuts to get lower mortgage rates. But if the Fed starts to move in a direction where we say they're more dovish, right, that means the whole dynamic has shifted for what we had to deal with for the last 18 months. And whether they cut 1 or 2 times or 3 or 4 times, if the economy actually does get weaker, which we don't want a job loss recession, but if that happens, 10-year yield is going to go down by itself. If the mortgage spreads get better by itself, not only are we talking about sub 6% mortgage rates, we could actually start talking about mortgage rates getting under 5% in that scenario. So the spreads between 30-year mortgage and 10-year yield is very high. We would be under 6% today if it was back to normal. So if the Fed goes into a pro-housing move, you have so many people sitting there waiting to buy homes, that couldn't. And then all of a sudden, you're just going to get a much better demand and much better atmosphere, lower mortgage rates with duration. And you don't necessarily need 6 rate cuts. But the market itself is already changing for the Fed. The Fed comes along. That's a very bullish case for home sales to rise. Not only that, you could also get refinances to come up again. We spent enough time with rates staying up high enough, long enough to where you could actually start refinancing some people too. So it's a much better backdrop, much more healthier backdrop going into 2024, where last year I thought the markets were overstating the U.S. going into a recession because we had a lot of global market stress. Wasn't so much about the U.S. We were able to minimize the damage from the banking crisis, but you got between the spreads getting better and bond yields going down, definitely. No more talks about 8% mortgage rates, but there's a case to be made that rates can get below 6% with a few of these variable factors coming in together in 2024.
Love that. Well, let's break that down for people. What do you think, in Logan, your experience, what would have to happen for rates to get below that 6 and nearing towards even that 5 that you mentioned? I think a lot of people are like, could it happen? What would need to happen? What should they be watching? What would have to happen to get down that low again?
For me, it's more or less the labor market has to get weaker. And not talking about a job loss recession, just talking about how the jobless claims data. That's my key line. I'm not a Fed pivot person. I didn't think the Fed was going to, pivot anytime soon. But job openings data is getting weaker. And that's what the Fed looks at. That's about how many jobs are open versus the unemployed people. Job growth is slowing down like it should. If the labor market just shows more balance and jobless claims picks up, you don't necessarily need a job loss recession. The 10-year yield can come down to about 3.37%. That was kind of my line in the sand this year in 2023. I brought Gandalf the Grey and I said, you shall not pass. This level will hold right until the recession happens. I don't see recessionary data yet. It held, but if you just get the labor market getting a little bit softer, the 10-year yield will come down. If the spreads get better, there you are. Simple as that. There's your sub 6% mortgage rates right there. And you don't need a job loss recession for that to happen. Now, if the Fed actually really becomes pro-housing, and the spreads get better for themselves and the 10-year yield starts to go back down, and they're very positive on their comments to do that, that could happen even quickly, more quickly than people think. But we have such a different backdrop now going into 2024 than 2023.
Yeah, it is really different. Yeah, coming in 2023, there was so much happening, and obviously to see 8% rates, but so many people predicting all these other variables are like, okay, it wasn't as bad. And I love that you're mentioning even that word stability and what's going to happen there, that it can stay for longer, because it would be nice.
Yeah, the stability is such a key thing, because I think people don't realize mortgage rates went from 3 to 6, 6 to 5, 5 to 7. That's nobody's going to operate in that environment, right?
Fast.
Sellers are buyers, so they're thinking, okay, well, what if I list my house and rates go up 2%? No. So my criticism of the Fed is that their job is to have stability in the financial markets. The mortgage market acted like a third world country when our dollar gets stronger and everyone's bond market goes haywire. We had that happen once. It happened again last year. It's time for them to just land the plane, as I say. Yeah. Land the plane, get people out, because a country has to be able to progress forward, and housing is such a big part of that. And every year that goes by where it's like this, we have people just waiting for rates to come down, and you don't want it to get to some point where you get a massive rush of people coming in with such low inventory. So we have to create a more balanced atmosphere for the mortgage market and for the housing market and for the U.S. economy, so we could just progress forward as a country. And that's the existing home sales market is at deep recessionary level still. There has to be a more coherent way to move that forward out there. And hopefully that's where we're heading into 2024. So there's a lot of positives in that front, because the growth rate of inflation has fallen now. We didn't need a job loss recession, like people said. And we could go into this year with a more, for the first time in a while, a positive pro-housing Fed.
Yeah, I love it. And we are watching it because, to your point, there is the feeling and the psychology of this pent-up demand. People feel like they might have missed an opportunity. They wanted to sell. Things didn't work out. And we don't have enough inventory, and rates do fall. Like, we create this new world that you have people flooding in and overbidding and all this stuff people are saying could happen
again. Millions and millions of people buy homes. I think one of the more interesting questions I've had is that people go, how did we get so many home sales with inventory so low? So you have to think of it in this way. Sellers are most buyers. We sell homes much faster now than it used to be. Like in 2011, it was 105 days. We do loans much more faster now. I mean, we could, transactions 7 to 8 business days, in some cases. If a seller lists their house, they get a bid right away. That home is going to close faster than it'll catch up to the inventory. So sales can rise and inventory doesn't grow any. That I think is a legitimate confusing question, because people go, how did home sales get up to this high with inventory being at an all-time low? So that's the seller buyer function, and things get done faster. Then you put the first time home buyer into the mix. You can get sales to grow in that environment. But again, it needs rates to stay lower with duration, get a calm marketplace, and people don't have to worry about listing their home and then all of a sudden rates go up 1.5%. Now they don't qualify. What are they going to do? Stability is key, not only just in 2024, but going out for the rest of the decade.
Yeah, I think so. And there's a lot of off-market deals. And to your point, sometimes people don't understand the inventory. There's sales that happen, I know, in our own local market that were off-market, really, right? And those things start to add in. You don't even know what's kind of happening because it was never listed. You never really went to it, went there. Which, speaking of, we had a good laugh before we started. So I want you to break down, this is one of the funniest things I've heard this year, of Wall Street buying up 44% of the homes. And for anybody listening, when I saw it, you broke it down right away, and I had to it was a good laugh. But for people maybe that thought this could actually be somewhat true.
Yeah, I mean, I've been dealing with the Wall Street is buying most of the homes nonsense for a very long time. So just to give people a good example of real numbers, like from 2011 to 2017, Wall Street bought, if I counted Wall Street firms and pension, 200,000 homes out of 36 million homes that were bought. It's very tiny. Because there's a new law that's going to be put into place that says Wall Street not only can't buy homes anymore, but they have to sell them. A story broke out that said 44% of all the homes in 2023 were bought by Wall Street. So I've spent the whole weekend just, creating videos and trying to show data. And, Q2 of this year, 0.4%. Missed it by this much, it was, I've heard some absurd, crazy lies about the housing market. That to me was the biggest, most absurd thing ever. That's like over 2 million homes being bought by, and they don't even have the capital to do that. So the smallest percentage buyer of the marketplace was now considered to be the most prominent buyer. And again, TikTok, Instagram, X, YouTube, grifters keep on pushing it. I mean, even this morning, I'm getting people who are making it their platform that 44%. And it's just not there. And all you have to do is show the data. You don't really even have to say anything. You just show the charts. And that's what we did in HousingWire. We took all the data going back to the start of the century, and even in the last few years, especially the quarter, to show that it's a very, very tiny percentage of the marketplace. So people have to be careful of who they listen to.
I always say, like, when did we throw out the common sense? If you take a look around your own community and what's happening in your cities, do you see that happening? Or is that maybe something you want to investigate? And your point, I love the detective hat.
Yeah, be the detective, not the troll, right? Right.
Well, speaking of the troll, there was some funny ones. I want to go back to the 6 rate cuts that are projected in that article. Do you think the 6 actually happen? I know you mentioned a few different numbers there. Maybe doesn't impact what we're thinking it impacts, but do you think they could potentially make those 25 basis point cuts along the way?
Here's a model for that. The Federal Reserve last year said they would like to have the Fed funds rate move with core PCE, the personal consumption expenditures, the year-over-year data that they track. That's their 2% target. That's down to 3.5%. It's heading toward below 3%. You can make a 6 rate cut presentation just based off of that, because the Federal Reserve is actually very restrictive right now. Mm-hmm. They're at 5.5, 5.25. The growth rate of inflation is falling. So based on their own models, they're very restrictive. They can do that now, and it would seem perfectly normal with where the growth rate of inflation is. The Federal Reserve is going to cut rates next year, even without a job loss recession. If the labor data starts to get weaker, they will cut more drastically. I think, if you want to look at it that way, look at in that context. Mm-hmm. That jobless claims data starts to pick up, especially if it goes over 300,000. That's your best case right there. But they can cut rates 6 times and be actually somewhat above neutral where the growth rate of inflation is at. So that's how I would present it to everyone right now. There's a case to be made for 6 rate cuts. Whether they do that, that's up to the Fed, right? Because they're very restrictive right now with the growth rate of inflation falling and the Fed funds rate so high. So when they talk about real yields or being restrictive, that's what they're mentioning. That's why they're talking about no more hikes and possible rate cuts in 2024. But the labor data runs everything. If the labor data gets weaker, you get more rate cuts. If the labor data gets stronger, you could just get maybe a few rate cuts into that. So that's the data line I would be focusing on in 2024.
Great explanation, because there were so many things out there. I'm like, God, we're gonna break that down. We got Logan next week. We'll go through it in more detail. I would love your take on this one too. Is looking at 2024 and the price appreciation and even the refinance market we kind of referenced that could come into play. Do you think that refinance market comes into play if rates get around 6, get below 6?
Oh, definitely. Even 6.5, you're gonna get. I mean, we saw the refinance index already pick up already. So definitely you could get more. The longer rates stay lower, the more refinances you could get, just because the supply has picked up because people have higher rates. In terms of price appreciation, just kind of go with the same thing as 2023. If inventory stays this low and demand is stable, price cut percentages still stay the same, you could get low single-digit home prices. There's obviously areas in the country where inventory is so low still that you get bidding wars. But kind of go with that. We track the weekly inventory data, and we don't see any surge in inventory. From 2000 to 2007, inventory grew every single year for 7 years before home prices started to fall in 2008. Back in 2022, it was such a crazy year that home sales collapsed so much so fast, especially in the second half of the year, that we had price declines on a month-to-month basis. But then demand stabilized. So if you have rising demand with low inventory, you're going to get nationally low single-digit price gains. So the inventory data is key. The only variable that could really change the inventory data is a job loss recession. And I always tell people this: since 30, 60, 90, and 120-day lates are near all-time lows, the foreclosure supply minimum takes about 9 to 18 months.
Yeah.
So you're looking at 2025, 2026 because there's no job loss recession yet. So you don't have to worry about that. But if rates fall lower and faster because the labor market's getting weaker, think of it as this: we have 157 million people working. The mistake I saw a lot of people make on COVID is that they kept on telling me, Logan, demand won't come back. There's 20 to 30 million people unemployed. There's 5 million in forbearance. I said, that's cute. I've got 133 million people still working behind me. My mortgage rates are 3%. My army's bigger than yours, right? So when the job loss recession happens, always just remember, majority of people are always working. Housing gets disproportionately impacted in a positive way with low rates. It gets disproportionately impacted negative with high rates. We had 4 million jobs created in 2022. We had the biggest home sale crash ever because rates went up so much so fast. So lower rates run the show, and majority of people are always working. So we just focus on the weekly data. That's how you get a single-digit home price growth next year, if that's the case. If you start to see a surge in inventory, especially if they're distressed sellers, that's a different equation. We're not there yet. Once we see it in the data, we'll let everybody know. But new listings data still trending at the lowest levels ever recorded in history. So not the story right now.
Love it. And we've covered a ton of stuff. So I want to equip people after they listen to this. They're like, okay, how do I follow along? What would you share? Maybe some of your routine, or you would advise people that are mainly in mortgage and real estate, right? They do this for their career.
So we have a top 10 Apple business podcast. Sarah Wheeler and myself, we have 2 shows that come out Thursday and Monday. We give you the most up-to-date information out there in a podcast form. We have a YouTube channel, HousingWire. You could go into there if you prefer YouTube. I have a weekly tracker at HousingWire. Every Saturday, I give you the active listings, new listings, price cut percentages, 10-year yield, purchase applications, and it's a model designed to look 30 to 90 days out. That gives you the most up-to-date information. We don't believe in waiting for home sales data, which is lagging. That gives you a real-time look so you can talk to your clients. The articles at HousingWire has tons of charts, and the charts are designed to be simple enough so people can understand. And if you really want to get bored and nerdy, my Instagram page, just my name, Logan Mohtashami, the story sections, we go over all the economic data. My work is not just housing. It's economic cycles first, housing the secondary. So the Instagram story section is not going to be fun and exciting, but it does talk about all economic data. My job is to connect the dots so you have a better understanding, because if you have a better understanding, you can talk to your clients. And then there's always that Uncle Dave every Christmas and Thanksgiving that thinks it's 2008. We want you to be able to tell Uncle Dave is, no, Uncle, it's not 2008. It's not this or that. So I try to make it as fun as possible, but my job is to educate. And then you yourself, if I do my job right, you all can finish my sentences for me. That's what I think about it, because models are very simple, standard. Things could change, but it shouldn't deviate too much. And my job is just to explain it. So the Instagram page, and if you have X or Twitter, there's a lot of good chart battles I have with the housing crash people on there a lot. So those are the avenues to find me. HousingWire, of course, my work is there with the podcast, HousingWire Daily. Again, my job is to connect the dots and inform and try to make it as fun as possible.
I love it. And you're doing a great job. I will tell you, we're going to put all the links, guys. So you're going to have all of those so you can follow along. We're going to make sure to tag so you know what's there. And my big challenge to you is as you go into next year, get ready for the holiday season because you can have some good conversation around this and you can be armed with the actual data and the charts. But going into next year, one of my big core beliefs is the reason we started the podcast. I know the reason that Logan and Sarah have the podcast is to educate and inform people on the actual data so you can be a pro in your market and actually help people make informed decisions. I don't believe you can do that unless you're actually following the trends and understand the charts and know the data. So make sure you're a pro, set yourself up in your goals for 2024 that you're going to listen to the show at least once, maybe 2 of them a week, and you have the information to make you have a competitive edge over your competition. That is something I believe in. Logan, thank you, because not only do you make it fun, because this stuff, let's be real, for a lot of people like to nerd out on this, it's like their brain might explode. As my 8-year-old, we were doing some math problems in the car, and he's like, Dad, my head hurts. I'm like, that's good. That means your brain's working. Be ready. But also the challenge is, if you were to put this into your business and actually follow along and have the right information, how much better could you advise your partners, your customers that are coming in? They want you to be their guide. So make sure you tune in. Logan, any parting words or anything that we missed that I should have asked you?
No, just, when I tour the country, and a lot of people that follow my work over the years, the one thing I've always got back is that thank you so much, because I can talk to my clients in a more informed way, and it's helped their business. So that's one of the reasons why I do this, just so it'll be easier for everyone to explain, because you don't realize what's out there is crazy, right? And unfortunately, the academic world doesn't have the personality to take on the grifters of all the social media sites, but I do. I'm very passionate about it. But again, my job is to teach, and then you become, your own economist in a sense, because you could talk about the data in a more informed way.
That's it, guys. Well, you don't have to be the expert as far as Logan is, but you can follow the information and what he shares, and then you can be more intelligent about the conversations you have. And as he said, then you guide people in the right direction. And that's what I believe we need to do more of. So until the next episode, guys, make sure you like, subscribe, leave us a comment. This one's been different. I love these kind of conversations. A few weeks ago, you guys gave us some great feedback about Rob Luna. Both Logan and Rob are on CNBC, and they're on there for a reason. Make sure you follow these 2 guys. Make sure you follow Logan and share what he is giving out. Some of this information, I'll tell you, if you were to start putting it out there, you become the trusted advisor. When you learn it, you understand it, you're the go-to person in your market. So until the next episode, guys, do something great, and we'll talk to you soon. See ya.